The price of crude oil has been extremely volatile these past few weeks. The US crude oil futures even went below $0 per barrel. It's kind of a good news for drivers, but don't think it means free gas or money back. So why did the crude oil collapse into the negatives, and how does that affect the price you pay at the pump? Negative pricing sounds illogical. The name suggests you will earn money when you buy something, not lose it. However, in the business world, the price follows the rules of supply and demand. Since the COVID-19 pandemic broke out and spread around the globe, oil demand has been slashed dramatically. When the buyers saw how much traffic has dropped, they purchased a lot less. But since oil drilling is a huge and complicated industry, and oil is a strong pollutant, the sellers cannot just stop their work or throw out the excess oil. The only way they can actually deal with it is lower the price or even pay the buyer to take their excess stock. Keep in mind that the oil price we normally talk about is the futures price. That number depends on what investors think the price of oil will be going forward. But when a figure as important as the May West Texas Intermediate contract dropped over 300% in a single day, it had a very small impact on the proportion of the active US oil market, since only few deals were made in the low points. And according to the US Energy Information Administration, crude oil prices only make up about 50% of gasoline prices. The rest are refinery and distribution costs, corporate profits, and taxes. Yes, you can use oil prices to predict tomorrow's gas prices, but the price at the pump is less volatile than the oil prices. And in China, there are things called the ceiling price and the floor price. The ceiling is currently around $130 per barrel and the floor is $40. So even if the price goes outside of those limits, the price at the Chinese pump won't follow.